Good morning, ladies and gentlemen. Thank you again for your early arrival. Here we go. Thanks. We get that down there. Okay. We will have a copy of the comptroller's speech will be available as you leave. We'll hand it out to you as you leave. I'm sure there's a lot of exciting things on your mind today, so let's not waste any time and move right over. And the Comptroller of Currency, Mr. Clark. Thank you, sir.
Thank you, Jim. Jim thanked you for coming this early. I probably should apologize to you for your having to come this early. I'm sure everybody's interested in what the effect on, or what my views are about the effect of the stock market drop yesterday. I started out to do what a friend of mine did last Friday, who is a stockbroker, and carried around in his pocket a little sheet of paper that had the answer to 4 questions on it. The first one said, yes, it did. The second one said, no, I don't know why. The third one said, no, I don't know when. And the fourth one said, probably. So I do think, though, that it is important to remember that banks do not invest in equity securities. And as a consequence, the stock market drop yesterday should not affect the investment portfolio of banks. And I think that to the extent that there is any effect on banks, it would be as a result of the effect on the bank's individual customers. Of course, one effect on the banks could be that a number of people got very liquid yesterday, and some of that money will find its way into bank deposits. Another effect could be that some of the bank's customers, some of the bank's borrowers got very illiquid yesterday, and that could result in some credit quality problems. But I think you have to look at it on an individual bank-by-bank basis, and that people should not be concerned, depositors in banks should not be concerned about the effect on banks as financial institutions or the safety of their deposits. So that would be my comment this morning about the stock market. Any questions? No, we should declare victory and go home. Yes.
The extent, though, that the stock market crash undermines just consumer confidence in the economy, I mean, what's that going to mean for banks?
Well, I think it remains to be seen whether it will undermine consumer confidence in the economy. I don't think there's any sign yet that that's the case. Yes, sir.
How about the effect on trust departments of banks and the customers thereof?
Well, obviously, anyone who had an investment portfolio in the market yesterday was hurt. The trust departments of banks, of course, are fiduciaries. They are not investing their money for the bank's account. They're investing the money for the account of their customers. And I'm sure that a number of those portfolios were reduced. But again, that does not affect the safety and soundness of the bank itself.
Aren't there a common fund, common funds rather run by trust departments which could be investing in equities?
That could be, but again, those common funds are being invested for the benefit of customers in a fiduciary relationship, not for the bank's own account. Yes.
The last time there was a stock market reaction of this magnitude, of course, it had very profound effects on banks. Could you comment on any parallels today, and also on the idea of changing the laws now, which grew up as a result of that earlier stock market?
I think one of the most important things to remember is that there was a big difference in the correction then and the correction now, and that is that I think a lot of people were much more severely affected from a liquidity standpoint and had no choice but to sell into an ever-declining market, and I'm not sure that's the case today. As far as any kinds of restrictions that you would impose on any rules and regulations that you would impose to keep something like this from happening, I'm not sure what that would be. Some suggestions have been made that we should not permit program trading. It seems to me program trading is simply a computer-driven decision-making process which could just as easily be made by people as it used to be. and that it becomes very difficult to impose rules and regulations on people's ability to make an investment decision to sell or to buy. So I'm not sure exactly how you would do that. Yes?
Notwithstanding the fact that we now have deposit insurance funds, which we didn't have in 1929, isn't there at least a possibility that we could have a run on banks if this thing continues, to the extent that those funds would be exhausted? And what would happen then?
Well, I really don't like to talk about those kinds of possibilities. I mean, there are all kinds of hypotheticals that we could dream up about what might happen under any set of scenarios, and I don't think it's very productive, really, to talk about those. Robert?
Has the Comptroller's Office, or to your knowledge, any of the other regulatory agencies set up any special monitoring today to look over the deposit flows at your banks?
Well, we don't have any special monitoring system in place, but as you know, we have several ways that we can do that on a continuing basis, irrespective of any particular event. In the largest money center banks that we supervise, we have a resident examiner, a so-called resident examiner, who's in those banks at all times, and it's very easy for our personnel in those banks to monitor what's happening. In the other banks, we have a network throughout the country of district and field offices, and again, it is very easy for our examiners to be in touch with the banks for which they're responsible and find out what's going on in their banks at any time.
Are you going to be paying closer attention today?
Well, I think we will be watching.
This fall, there's been a big effort, especially by the larger banks, to go to the markets to try and raise their capital base through offerings of stock. What is your expectation now that the climate seems to have changed?
Well, there is no question that the climate for raising new equity capital has changed, and I think that those banks who were successful in having their equity offerings before the climate changed are obviously feeling very pleased with themselves, and those who did not get their equity offerings done are going to have to go back and reassess how they might do that. But this is certainly not the time for them to be trying to raise new equity in the market.
Will this affect the way you as a regulator would be trying to convince banks to be raising their capital?
Well, not really, because I don't think we have required banks or have imposed any obligation on banks to increase their capital in any particular way. There certainly are other alternatives to raising equity capital in the markets, and I think we would just wait and see what the bank's plan B would be as a result of all of this. And also I think it's important to remember that this is a continuum. This is not the end, presumably, of the equity markets, and there will be an opportunity at some point for banks to raise equity capital. Yeah.
Would you comment on the health of the banking industry that you regulate, particularly over the past year? Is it up? Is it down? Is it declining?
Well, that's a subject that we could almost spend all morning on, but to try to give you a short rendition, I think it's safe to say, I would say that I think the banking industry, particularly the national banking industry, is in general very safe. All of you know that banks over the last several years have taken some fairly heavy body blows from a variety of things, ranging from LDC debt, which resulted in large reserves being set up, to bad real estate loans, to bad energy loans, to bad agriculture loans. And all of those have severely impacted banks' earnings, and they've impacted banks' capital. Fortunately, I think that a lot of those problems seem to be behind the banks. At least they have been contained. The reserves have been set up, and workout arrangements are underway to try to get some of those loans collected. Going forward, I would hope, and I think we're seeing a trend that would indicate that the loan losses are not going to be as heavy. But having said all of that, I think most of you know that I have been concerned, and our office has been concerned for some time, about an underlying weakness in bank profitability. If you plot that on a graph, you see that that has been occurring over a long period of time and has been made worse by downturns in certain economic sectors, but even before those downturns occurred, was in place. And I think that's the reason that we feel so strongly that banks' competitive opportunities need to be expanded. Yes.
Clark, one of the, yesterday, I think it was Frank McGuire who mentioned that the structure is a new buzzword going around on the Hill, and wondered if you thought that was a healthy development or might interfere in getting some more immediate powers and services passed for banks.
I think it's a very healthy development because I think that structure is really the key to getting greater competitive opportunities for banks. I think all of us who have been promoting that have been suggesting that probably the most competitively fair way to do it and the best way to do it from the standpoint of safety and soundness of banks is to set up a structure that allows the banks to compete, allows the banks to be involved in these various other activities, but at the same time puts some limits on the transactions that banks can have with those affiliates and protects the safety and soundness of the bank. So I'm delighted that people are focusing on structure as a way to bring about that change. In fact, I'm delighted that people are focusing on the need for the change. Yes.
Sir, banks do have a lot of bonds in their portfolios. How have the recent gyrations in the bond markets affected banks, and what will happen if the slide in bond prices resumes?
Well, the gyrations in the bond markets have affected banks adversely, and you've seen various public announcements by banks that they have suffered losses in their bond portfolio. This is not the first time that's happened, of course, but during this last decline in the bond market, they have suffered some losses. But again, the amount of debt securities that can be held by banks is generally limited, can be, I mean, is regulated, and also is just limited as a matter of prudence. And I don't think that you're going to see that decline doing any banks in. Susan?
Would you comment on whether you feel a slide in the Tokyo stock market will have an impact on the Japanese signing on to risk-based capital requirements?
I would not. I really don't have a very intelligent comment to make about that because I don't know if that will have an effect. One of the things that we have talked to the Japanese about, of course, is how they would deal with their so-called hidden reserves, which in large part do represent equity investments in corporations. And the proposals that have been kicked around to the Cook Committee have all envisioned that there would be a fairly steep discount applied to those equity investments before they would be allowed to be included on the balance sheet as assets for capital purposes, for the very reason that there was a concern that the values of those assets could drop. There would also be a requirement that they be marked to market on a periodic basis. So the structure that was set up to deal with the Japanese equity investments can accommodate and was designed to accommodate a drop in market value. Now, whether this will have an effect, an adverse effect on the Japanese participation, I don't know. My inclination is that it would not have because it's something they had already anticipated might happen. Yes.
Will the administration push to repeal the Glass-Steagall Act?
Will the administration push repeal of Glass-Steagall? I think the administration's position has been pretty clear all along that it would like to see greater competitive opportunities for banks. For the last 7 years, various suggestions have been made by various people in the administration trying to get something done to improve competitive opportunities for banks. I think if there is such a proposal forthcoming, the administration would be very supportive of that. It depends on what it would contain.
Are you trying to formulate any kind of administration position?
Well, I think, again, we're waiting to see what emerges from the Banking Committee. There has been a lot of discussion going on in the Banking Committee about what form any change might take, and I think that we're waiting to see. so many different proposals have come forth from the administration, and so many of us have been talking for so long about ways to do it. I think we're waiting now to see whether any of that has stuck at the committee level. Yes.
Could you address the possibility that regulators will require banks to declare Brazil's debt value impaired?
I really don't think it'd be appropriate for me to comment on that. That's something that's going to be taken up by ICIRC, as you know, when it meets this time, and would really not be appropriate for me to comment other than to say it is on the agenda. Yes, sir.
Mr. Clark, there are, could you tell us how many non-bank bank applications you have now in limbo, and whether you're going to ask Congress to reverse itself on the freeze?
Well, now you've asked several questions. Are you, by the freeze, are you talking about the moratorium?
No, the fact that the non-bank bank freeze is not permitting any new ones to be authorized.
It is not our plan to ask the Congress to change that law. You know, there has been so much bloodshed over that issue that I think we'd all be better off if we got on to something else.
But how many do you have in your office now? It was around 300 or 400, wasn't it?
I can't. There were at one time 300 or 400 applications. I can't tell you how many there are now because the issue has really become moot unless the law has changed. None of those applications are going anywhere. Yes.
At the banks that you oversee, have you seen any problems with loans collateralized by securities or loans to securities brokers, and do you have concerns in that area?
Well, your first question is, have we seen any problems, not any inordinate problems? I mean, no more problems peculiar to loans to investors or to the securities industry than to any other industry or group of borrowers. As I suggested, as a result of the decline in the market yesterday, it remains to be seen what effect that decline would have on individual borrowers or groups of borrowers. But it's too early for us to be able to assess that. It's not going to affect the banks broadly. It's going to affect banks on an individual basis, much as the decline in energy prices or other commodity prices affected banks on an individual basis, depending on where their loans were concentrated.
Are there some banks that are heavily concentrated in those areas?
I don't think so. Yes.
This time yesterday, Mr. Seidman stood up there and said that he expected the number of bank failures and the number of problem banks to peak this year and diminish by 25% next year. Do you still think that that's a valid forecast?
I do. We have been observing the trend in our problem bank list, both the list that we keep for national banks and the list that the FDIC keeps for all banks. And for several months now, that list has been remaining very, very stable, and in fact has come down from its high. And we are very encouraged by the fact that we hope means that we have contained have identified all of the primary damage and are now working with those banks to get themselves back to health. So I think the problem bank list will continue to come down, and I think the number of bank failures could be dramatically less next year.
How many problem banks are there right now?
The number, it depends on how you measure problem banks. The number of problem banks of national banks, which are the 3, 4, and 5 rated banks, something on the order of 1,250.
1,250?
Yes. Now, I think you need to be careful to not overdo what problem bank means. I mean, on a scale of 1 to 5, where the bottom 3 categories are included in the definition of problem banks, you know, 3 rated banks are not that much of a problem, but they are problems. And so in order to, and then what that means is that we then start providing special supervision to those banks. So please don't go out of here thinking that 25% of the national banks are about to drop off the cliff. That's not the case at all.
How does that figure compare with a year ago, the 1,250?
Just about the same, possibly a little bit lower.
banks, yesterday it had the securities powers. Would you have been as confident today as you have been so far? Would the banks have been affected more if they had been heavy into the market in a different way?
Well, that's where you get back to the structure question that was asked earlier. One of the main reasons that we have been urging that greater competitive opportunities, particularly in the securities area, be done through affiliates of banks is to protect against just what happened yesterday, to the extent that the brokerage firms are adversely impacted. Now, a lot of people made a lot of money handling those transactions yesterday, so it wasn't from the standpoint of the broker. Yesterday may not have been such a disaster, but to the extent that losses were realized by the investment banking firms yesterday, if those banking firms had been affiliated with a bank through either a subsidiary or an affiliate of a bank holding company, and you had the right kind of insulation between the bank and the affiliate, the bank would not have been affected by what happened yesterday. And that's precisely the reason that we are urging the kind of structure that we've been urging.
Talking about putting everything in affiliates that would be regulated by the Federal Reserve.
We are talking about putting things into affiliates that would be functionally regulated. And if the underwriting of commercial paper or the selling of other investment securities is something that would normally, if conducted by an investment banker, would be regulated by the SEC, then we would suggest that it be regulated by the SEC if it were affiliated with a bank. That it would be put in a subsidiary of a bank or a subsidiary of a bank holding company and regulated not by the bank regulator, but regulated by the securities regulator. And the bank regulator obviously would have to have a good working relationship and coordination ability with the securities regulator and would have to monitor the bank's compliance with the so-called firewall devices to put the barrier between the bank and its affiliate. But we would not envision being in the securities regulation business.
Well, apparently the way Proxmire's bill is now, the Federal Reserve Board would determine like what activities banks could do in the securities area and which securities firms would be able to affiliate with banks.
Well, I think people should not jump to conclusions yet about what form that bill is finally going to take. I think there's a lot of fluidity in that, and you know, a lot of people proposing lots of different ideas, and I don't think we should assume that any one particular approach is going to be taken at this stage of the game.
Do you have a sense on whether the moratorium will be extended next year, and what are the prospects in your reading of reform legislation next year?
You know, I'm the eternal optimist, so I still maintain that first of all, I think there is a very good likelihood that the moratorium will not be extended. For one thing, a number of members of Congress have indicated very vociferously that they will not support extending it. Now, that doesn't mean they can't change their minds. All of us reserve the right to change our minds, but there has been a lot of rhetoric about the undesirability of extending the moratorium. Secondly, I think you have a lot of factors coming together that, and one of the things I'm going to say in my speech this morning is that this may be one of the best opportunities that we've seen in a long time for all of the right factors to come together and result in some change. And so I am very optimistic that something can be done, and hope that the existence of this particular climate will spur the banking industry on to keep the pressure on the Congress to make sure that it does happen, because I think there's a great opportunity here. Bob?
My understanding from your staff's comments yesterday was that you can continue to accept applications from national banks seeking your sanctions on various new powers or new activities, but you cannot approve them in a final form. Does this suggest that should the moratorium end, there's going to be a major flurry of endorsements for new activities?
Well, a couple of things. First of all, we can accept them and we can approve them. The banks just can't implement them. If we were to authorize an activity that had not been authorized prior to March 5th of this year, It could not be implemented by a bank even if approved by us in the case of a national bank. I think a lot of people who would like to move beyond the areas that we have specifically approved are holding off filing any applications with us, waiting to see what's going to happen with the moratorium. It is, after all, not that far away. March 1st is not that far away. And so we have not seen, and I wouldn't really expect to see, a lot of applications for interpretive rulings filed with us, because I think there is a high level of optimism that something could be done structurally by March the 1st, and if not structurally, that at least the moratorium would not be extended. So I guess I would not expect a great blizzard of activity to take place on March the 1st. I would expect that if the moratorium is not extended and nothing is done about structure, then the banks are going to have to go back to the drawing board and try to deal with the world as they found it before the moratorium was imposed. Yes.
How might depressed stock values speed up or slow down the wave of bank takeovers, and what might the effect be on pending acquisitions?
Well, that's an interesting question that I think you have to sit back and wait to see what happens. Clearly a change in stock values could affect some of the transactions. I guess a lot of it depends on what the terms and conditions of their acquisition documents are, whether there are any rights to get out of an acquisition if the stock value changes. And also, I think you need to remember that the fundamentals of a lot of these transactions were not changed by what happened yesterday. It's simply a change in the value of the stock market took place. And a lot of people who felt that these acquisitions made good sense are likely to feel that they still make good sense. So I think it's much too early to tell what effect this would have on pending acquisitions. Yes, sir.
When the decline in the stock values actually increase these acquisitions, sir, because the breakup value of these banks will be much, much larger now, and therefore speed up mergers and acquisitions among the banks now?
Well, again, I guess I'd have to give you the same answer that I gave to the other question. It's too early to tell. There's no question that it would cost less for someone to try to acquire stock in a bank today than it did yesterday. But whether that's going to prompt someone to attempt an acquisition, I think just remains to be seen. You just have to wait.
Time for one more question.
Yes.
Does it all concern you that if a mistake is made in establishing this structure for further deregulation, the consequences of that mistake? In other words, could we see something in the banking industry that we've seen in the thrift industry when it was deregulated? Does that worry you if there's just a small mistake made or something is overlooked and you don't get this wall between the affiliate and the bank? Or
Well, I guess in connection with the analogy that you gave to the thrift industry, the wall wasn't there. The mistake was made, in my judgment, in not putting the wall there. My feeling is that these proposals have been thought through very thoroughly, and they've been debated very thoroughly. And I think everyone feels very comfortable that the kind of structure we're talking about putting in place will take care of most problems. Now, no structure is perfect. I mean, the structure we have right now isn't perfect. And no set of laws and regulations are going to keep people from violating laws and regulations if they want to. That's why we have bank supervisors. If everybody would pay attention to the rules and regulations, we wouldn't need bank examiners. So I think that there is always going to be the possibility under any kind of structure you can conceive that somebody will violate it, and that the consequences of that violation may do harm to an institution. But we have that present today, and I think the price of keeping banks out of greater competitive opportunities with the fear that something, somebody someday somewhere will break the law and hurt an institution is too high a price to pay. I think it is exacting too high a price on the banking system as a whole, And we just shouldn't allow that to happen.
Thank you very much.
Thank you all.